Well, good morning, everyone, and a really warm welcome to the inaugural Young Economists Conference. My name is James Whiston. I'm Head of Economics here at Dulwich College, and it's a real pleasure to welcome everyone today. We're delighted to have students from across the Southwark Schools Learning Partnership, but also from schools across the country. We've got students from up to 20 schools today, which is fantastic. You're all incredibly welcome, and we hope you have a really, really nice day. A little bit of housekeeping before we begin. I'm just about to send out a message to everyone on Zoom via the chat. We're doing polling today using slido.com. Our event code is 353372. You can log on there and you can answer questions from the speakers and also put your questions to the speakers yourself. Please would you give your first name so we can give you a shout out when we use your question. For each of the talks, we've got two Dulwich students who'll be running a Q&A. So for this morning's talk, we've got Yano and Lorenzo who'll be running that and putting your questions to the speaker. That's it from me. Please get involved today. And at this stage, I'll hand over to Yano to introduce our first speaker. Thank you.
Morning to you all. I would like to give a warm virtual welcome to Helen Thomas, CEO of the independent consultancy firm Blonde Money. Helen, who will be discussing the role of financial markets, how they work, how they fail, and how the COVID-19 pandemic has changed.
Great, thank you so much, James and Yano, for the warm welcome. And I'm hoping that we're radiating virtual warmth, even though we're not in a room together. But of course, the benefit of that is I believe that there are many of you joining us from up and down the country, which is excellent. So whether you're, in bed, having your cereals, cup of coffee, I can only dream of what virtual school must actually be like. I really hope that you will enjoy this kickoff session, because what we want to talk about is financial markets and how they're relevant to you. So as Yano was saying there, I have 20 years of experience in financial markets and politics. I run Blonde Money. The name itself is supposed to be a challenge to the group think out there. And I hope to be challenging the way that you guys think today. Right, well, we are going to try this new technology with the polling that James mentioned there. And before I say anything more about financial markets, I want to know, what do financial markets mean to you? What is the one word that you would associate with financial markets? And hopefully, if you have gone to slido.com and typed in the code, I'm just going to look, it's 353372. If you put that in, then you should be able to give us a sense of the words. And I think the words are coming in because James is nodding. I'm going to try and look on my phone to check about this as well. Let me see. I'm going to put in my own word. Oh, great. Very enjoying seeing some of these come in. I wondered how long it would take for someone to say Wolf of Wall Street. That is great. Good words. I knew there'd be great words from you guys. I knew you'll be more awake than me at this time in the morning. I don't know how many more we've got coming in. I'll just give it a few more seconds. Yeah, slido.com 353372 for anyone who hasn't got it. I'm pretty sure you're all going to have mobile phones, so that's not going to be an issue. So some great words in here. Okay, so this is what I'm seeing. Money is a big one, but also volatile alongside things like crazy and chaotic. So that is good to see. Corrupt, interesting, and of course powerful. And powerful, that's very much something I'm going to pick up on in a second. Please, feel free to keep those words coming. I'm sure James will save this word cloud. I would love to circulate it to our clients, because you know what, you guys love your fresh perspective on things. But money, volatility, power, absolutely. That is what I want to talk to you about today, because this is the thing about financial markets, is we all need to know how they work and what they do. It doesn't even matter if you're not doing economics, and I know not everybody on this call necessarily is. Financial markets are what moves money around the world, and that means they change the world. They change everything. They drive everything. We all need to know about the mechanics of this. So For example, of course, you know, you've got things like the rate on your mortgage. Now, might not matter to too many of you right now, but of course that affects your monthly incoming and outgoings if that moves around. You've got things like credit cards and the cost of credit, very important for spending. If you're a business, then you know the rates of interest are going to potentially determine whether you survive or not. So businesses can just disappear if the markets move. Your parents' pensions might sound very dull, but if they've got one, and hopefully they have, then that is going to be very important for what happens further on in their lives. And that is totally affected by the markets. And then there's things like inflation, which I'm guessing if you are studying economics, you'll have come across. But of course, super important is the actual price of money. You know, we all know about how if there's a lot of inflation, it's actually going to end up being more expensive to buy things. So all of those things maybe sound abstract, maybe sound very boring, but they are absolutely fundamental to how we live our lives. And so this is where I like to call financial markets the beating heart of the world. And they always have been. You know, this is not some newfangled phenomenon. You go back to farmers and their crops, and they created futures markets because they wanted certainty over how much money they would get to sell those crops. You've got places like Venice. It's so integral to the world because it was a trading center. It's about how East meets West culturally, as much as about the exchange of goods and assets. And of course, financial markets behind things like infrastructure and, you know, the advent of railways, and now with things like broadband, you know, that markets at the very heart of all of this. And the market is about managing risk. Life is all about risk versus reward. And markets are no different, but they just put more of a price on that. Now, when financial markets stop, that is like a global heart attack. And a taster we got of this was in the 2008-9 global financial crisis. But of course, most recently, March 2020, where the markets plummeted, that was an even bigger event. And we are going to talk in more detail about that and what it all means. But I would just take a second here to talk about the financial crisis, because I noticed from some of my interns recently that although it's very recent in my mind, I mean, I guess even for you guys, you're possibly even toddlers or something when all of that was going on. But it is really a really important historical lesson. It's really fundamental to understanding how economies work and banks and what they mean for us all, because I can't emphasize it enough, actually, that when banks fall over, it's like turning on the tap and no water comes out, or you try and flick a switch and there's no light, there's no power. It's a utility. Money moving around the world is a utility. And in 2008, when the banking system came under serious stress, we were at a point, even in developed world economies, that you could have gone to a cash point and been unable to withdraw cash. And I'm sure that you may get the sense there that potentially, you know, you're only a few steps away from anarchy, frankly, and the breakdown of society, if that happens. Just in the same way as if you couldn't have water or electricity for a while, that would be a serious problem. And I absolutely recommend to you a couple of things to read or watch. If you haven't already, please watch The Big Short. It's great. I've seen it 7 times. I think it should be on the curriculum. Sorry, James, you're probably not allowed to show it in school because there are some slightly risque moments, but as a history of what happened, it's very relevant. It actually explains financial concepts very well, and should give you more of a sense of some of these weird jargon that you hear about financial markets. What does it really mean? Another book that's worth reading, because The Big Short actually started obviously as a book. Another book to read would be actually Alistair Darling's history of the financial crisis. He was Chancellor of the Exchequer at the time, and it's quite a frank and honest account of, as Chancellor, what were they doing when this banking system was on the brink, and they were genuinely concerned about the breakdown of society and what it means. So we're going to talk more about the more recent history of the last 18 months shortly, but that is a brief moment on why financial markets matter so much to us all. I'm just having a quick look, by the way, at the word cloud, to see if anything extra came in. Well, we just got capitalist, greed, competitive, unpredictable. Very good. Isn't life unpredictable? Isn't it always about trying to make sense of the world in which we live? Okay, so what are markets? That's where we're now going to go. What different assets are there? Well, you've got equities, bonds, currencies, commodities, and property. Broadly speaking, are the big markets. And the biggest one of all is equities. And it's called stocks and shares. What does that actually mean? Forgive me for some of you, you may well know about this, but let's just start from the foundations and build it up. What is a stock? What is this share in a company? Well, it is literally that. It is literally taking a share in the profitability of that business. By buying that share, you own a little sliver of the equity of that business. You are, by buying it, hoping it, of course, will be profitable. You're believing in it. You believe in its business model. You see in the future it's going to go to higher valuations, and you want to be a part of that. That is a share of the business. Now, of course, there's a risk attached to that. You might be wrong. It might not be as profitable as you thought. In an absolute nightmare scenario, it might turn out to be entirely unprofitable and close down completely, in which case you lose all your money. But if it goes very well, you're going to make a lot of money. So it's a risky investment, but it can have a big return. We're going to talk about one stock in particular now, just to kind of illustrate this. We're going to talk about Apple, and I'm sure you all know Apple well. And we're going to just ask the very quick question on Slido, which is, do you own an Apple product in your household? It says a very, very simple yes/no question. I'm actually just interested to see the number that comes in. We've got about 40-something participants, and James, is the question live? I think it is.
Yes, it's live now. Yeah.
Thank you very much. So I'm going to put mine in. Obviously, guilty as charged. I absolutely do. Oh, we apparently have some no's, which is slightly surprising, but 4% so far. That I did expect there to be yes, an overwhelming yes, which is obviously where we've got to. Now, that is quite amazing, actually. I mean, God, over 90% of everyone on this call, has an Apple product. I mean, it is, of course, so well known. It is the most valuable company in the world, currently worth around $2 trillion. Mind-blowing numbers, but it really is worth that. They are sitting on a cash pile for research and development that is bigger than the GDP of some countries. So yes, huge business. But I should point out to you that despite all of this success, if we think of the second largest company in the world, I would doubt that any of you have their products, because it's Saudi Aramco, which is the Saudi Arabian oil petroleum business. So you're never always sure, what these really valuable companies actually do. But most of the top ones are in the technology sector. The third biggest is Microsoft, then it's Amazon, etc. So Apple, here is the big question that anyone in financial markets, this is the question that they're asking themselves every single minute of every day, which is, do you want to own a share in that business? And I'm going to just share my screen for a second and show you the long-term share price of Apple. And then I'm going to ask you a poll and say, what do you want to do with this Apple stock? So this is the entire history of Apple, obviously trading up there now. It's at $142.84. Do you want to buy it, sell it, or you don't know? That should be our latest poll. So let's just see, what would you do with a share in Apple today? Buy, sell, or you're not sure? I'm going to make my vote. Okay. Currently, fairly evenly split. We've got sort of 40% buy, 40% sell, just over 10%. I'm not sure. See if that shifts at all. Oh, it's buy and sell are pretty neck and neck here. Interesting. Now, by the way, one of the things about financial markets is you have to ask yourself, do you believe in the wisdom of crowds? So when the crowd has voted, are you someone who believes in that wisdom and you'll go with it? Or do you think it's a contrarian indicator? Everybody's been sucked in and you actually want to go the exact opposite direction to the crowd. And that is often an investing style for some people and some companies. So still very much neck and neck. I've currently got on mine 44% want to buy, 42% want to sell, and 14% are not sure. And I have to applaud the conviction rate here. There's only the 14% on the not sure. But sorry to do this to you all. It is a trick question because what's your time horizon? That is what is absolutely so integral to financial market decisions. Is this something you want to buy and sell this afternoon, buy and hold for 20 years or 50 years for your pension? It matters hugely what your time horizon is, as we can see from this chart. I mean, what is so astonishing about Apple? Yeah, it's worth 2 trillion here, but look, in the last year, I mean, it's basically more than doubled. Quite incredible. But look at this, prior to 2007, which I think was when the first iPhone was released. I mean, look, it's trading around $3 there, more than 143 now. I mean, that is incredible. But that entire period from when it went public in the 1980s, not doing very much at all. I mean, I don't know how much you guys know of the history of Apple. Another great thing to read about. But of course, Steve Jobs, who was integral to its success, he actually left the company in the 80s and only came back later. They spent so much money on their product and it was so expensive. And even in the 90s, this beautifully created product with wonderful advertising, people still didn't really want it. It really wasn't about a Mac. And really, the iPhone only took off when it combined the iPod with it. So you could listen to your music on your phone and then take photos on your phone. Of course, again, just trying to figure out how old you all are, that may be something that hasn't even, you don't remember that you couldn't do that you didn't have something in the palm of your hand that would play you music or take photos, or indeed now, order your dinner or get you a taxi. All these things you can do literally in the palm of your hand. Quite amazing. So there has been this amazing growth, but if we were conducting this poll in 1984, all of the sellers might have looked quite good for 20 years, but suddenly then the buyers look like geniuses. But even then, look, if you bought it here in 2012, 3 years after the financial crisis ended at just under $24. By a year later, it's at $14. So you've already lost about 40%. It's, these are the big decisions that you have to make. These are the risks you have to take. But of course, as I've said, you take the risk because look at that, boom, that spike, that's your potential return. So that is a brief point on equities. I'm slightly cantering through all of this because I know we don't have very much time. And I should say, I'm looking forward to your questions, but equally, I'll pass on my contact details to James and you can come back to me if you have further questions on all of this, because it really is important to understand it. Because of course, Apple couldn't have achieved such great heights if it didn't have that backing and support on the stock market. It uses that money to, do research and development, create new products. But there are other ways of raising this money, and the other biggest market is the debt markets. You can do it through bonds. So in that first situation where you had a share in the business, today you give Apple $142. They go and do something lovely with it. You will hold your share, but if they go bankrupt, that piece of paper is worth nothing. You get nothing. But you could just do a bond, which is where Apple issues debt, an IOU. And you say, all right, Apple, all right, I'll give you $1 million, but in exchange, I obviously want you to pay me some interest. And then, I'll lend it you for 10 years. The end of 10 years, I want all my money back. Now, what then determines that interest rate? Well, it's going to depend on the general level of interest rates, because you start off at this risk-free interest rate, which is usually the government bond rate. And then it's about Apple as a business and whether you think they're credit worthy. Look, you know, I've just met Yano and Lorenzo. Would I lend them a tenner overnight? Interesting. What will I judge them on? They both look very well groomed. They're clearly smart guys. Probably going to charge them not too high of an interest rate. Maybe I'll lend you 10 quid, but you have to give me 11. You know, I'll get 11 back. I want £1 extra for that because I've only just met you. If I knew you really, really well, it might be 10p, you know. And of course, if I lent it you for a week and then 3 days time, James rings me up and says, well, Yana didn't come to school for the last few days. I think, what's happened? Something odd's going on there. I'd be on the phone saying, I need a bit more money. I need a bit more money here. I've got to change that interest rate. And that's where the price of the debt moves around because of this credit worthiness of what happens to the issuer. And actually with Apple, you know, they're so much money, so profitable, they're considered very safe. But, you know, let's consider a travel company, April last year. What are you thinking there? Overnight, their business has disappeared. What interest rate should you charge? Are you going to get your money back? I mean, can you even, is there an interest rate that even covers all of that? And of course, often there isn't. And that is when eventually a business will go bust and go into a bankruptcy proceedings. And then what happens when you're a bondholder is you should get some sort of payout from the administrators. They literally go into a business, they grab any physical stuff they can find and they just auction it off, even if, you know, computers, chairs, carpets, rugs, whatever, sell it all off, see what money we can get. And hey, I know you lent them 100 quid. You're going to get back 50, but you know, at least you got your 50 quid back. If you were an equity holder, you get nothing because it's done. There's no profits anymore. It's gone. And that's what I mean about the risk and the return. So that Apple share that you bought, you might make 100% of your money. It might be brilliant, but if it goes down the toilet tomorrow because suddenly someone decides, I don't know, Apple phones catch fire or something and the business model disappears, you get nothing. But if you were lending them money, you'd have been picking up interest payments. And you then hopefully, as I say, get a little bit of money back at the end of the whole proceedings. And so that's the key difference between stocks and bonds. It's to do with their riskiness and the return that you get. I should say with bond markets, you should also be aware that governments have bond markets. Many of you may already know this, but it's the same principles, which is, you know, look, right now, you know, in the UK's debt, as I'm sure you're aware, has exploded because the government has borrowed to spend to keep the economy going. And, you know, back in the 90s, debt to GDP ratio in Britain was like 40-50%. After the financial crisis, they had to bail out the banks. So it went up to like 80-90%. Now it's over 100%. And you might say, well, is that sustainable? Then you're judging the credit worthiness of a country, which is like a whole different ball game. It's 65 million Yano and Lorenzo's, you know, and not just them, but, you know, that Boris Johnson and Rishi Sunak know what they're doing with that borrowing that they created. You know, are they going to get the growth? And I should say, though, that although those numbers, you know, are eye-watering and they're big, Japan actually has debt to GDP ratios around 250% and has for a very long time. Japan is a great one, by the way, to look at for a general kind of economic and market history. In the 1980s, it had this huge boom. Everybody loved it. Money was flowing in there. Real estate was going through the roof. And there was some mad things that happened, like, you know, Tokyo was worth more than, I think, America. I mean, it was just insane. And then the bubble burst. And actually for Japan, they had to borrow a lot of money to just keep going. It went on and on. The growth just dribbled away to pretty much nothing. And everyone called it Japan's lost decade, which was actually about 30 years ago now. So it's rather more like Japan's lost decades. But that is what can happen, you know, when markets go pop. So sorry, let me just check on time. We've only got, is it 20 minutes or so for the slot? And I know you want to do questions. Is that right, James?
You know, 5 to 6 minutes. So Helen.
All right. Well, let me just jump then to what's going on now, and what happened last year. So March 2020, I don't know how many of you were watching financial markets at the time, but on top of the health crisis and the economic crisis, the financial markets had a crisis, even worse than what happened in 2008-9. And I've never seen anything like it. Share prices were collapsing, falling, halving overnight. As I've said, because the business model is just disappearing. Who knew if anyone was going to get on a plane ever again? Actually, 18 months later, do we yet know that? So I want to get over to you that the world stopped, and that from a financial market perspective, that was disastrous, because if the market stops, then you would have had a financial crash on top of the economy itself falling and the health crisis, which would have, frankly, potentially got us into a Great Depression scenario where you lost a third of GDP and don't get it back for decades. So that was historic. And what was even more historic was the response to that, which was policymakers pumping money into the economy. It wasn't just furlough schemes, paying people's salaries. It's about the central banks of the world were pumping dollars, pounds, euros into the markets. And now, thanks to that intervention, stock markets in the US are at record highs, which seems a bit mad considering, we're still in a recession and we still haven't worked our way through the pandemic, but it's all about liquidity. And this is another key point about financial markets. What should the price be? Actually, I'm not going to do a Slido on this because we'd get a lot of answers, but how much would you give me for this iPhone, right? What's your price? What would you buy this? I think it's an iPhone 8 or something. It probably looks pretty rubbish to most of you, but what would you give me for this? And if 5 of you give me a price, that's very different to, I don't know how many people have got on now, but like 105 of you giving me a price. The more participants, the more liquidity. The closer the price becomes to, everyone kind of meets in the middle. And the more liquidity you have, the more functioning a market becomes. If a market breaks, which is actually what happened in 2008-9 with the mortgage markets, because people didn't know what houses were worth, or if people were, could service those mortgages. If there's no price, there's no market, the whole thing falls apart. And that is incredibly frightening, and you should be slightly frightened that it's happened kind of twice in your own lifetimes and 3 or 4 times in mine. But the good news is that the policymakers step in and they do have some answers. The central banks become this buyer of last resort. They step in and they do something called quantitative easing, and they buy bonds, and that helps to get a market moving again. So I'm going to do my final question to you all, though, right? And this is what I love about financial markets, is that you have as much chance of getting this right as me, which is, when do you think the economy will be back to normal? I think we've got, what are our options here? This year, next year, or never. So what have we got happening here? And of course, we don't know. As I say, you've got as much chance of me of getting this right. That, by the way, is why a career in financial markets is great, because yes, experience counts in some regards, but who knows what's going to happen tomorrow? Perhaps experience informs you, but perhaps it gives you, makes you a little bit jaded, and a new fresh perspective could be more correct. And of course, in a financial market, there's a number by your name. Did you get it right? In that share price chart of Apple, did you buy at 23 and sell at 143, or did you buy at 23 and sell it at 14? One of you looks amazing, made a load of money. The other one lost a lot, doesn't look so good. You might be unlucky, but at least it's like a clear way of marking your work effectively. So what have we got here? When do you think the economy will go back to normal? I see, well, only 4% this year. Okay. Thought might see more for that, but 60% next year and 36% never. I am in the 1/3 of you who think never. I think that the world has now changed. I think we should embrace that. I think it's great. I think it's exciting. I think your generation, much as you've had an awful lot of troubles through this last year, and it has been very difficult, face a great opportunity. My generation, we're still getting used to, living and working virtually. You've been doing it for most of your lives. So I'm going to leave you with this sort of, actually something I'm going to steal from something I saw on Twitter. So it was something last year, kind of summer of last year. Somebody on Twitter said, I keep thinking 2020 is the year I'm going to tell my grandchildren about. And then I realize it's 2019. And that, I think, is what we should all be thinking about. And that is what's going to change economies. It's what is going to drive financial markets. And if it moves markets and money moves around to the sectors like online that are got great opportunities and away from a world that is more physical, there's going to be great opportunities for jobs, for countries, for people. But it's completely different to what we had before. So, I don't know how many of you are students of history. I think it's good to know a bit of history to sort of look forwards in financial markets. But we are going through a technological revolution like the Industrial Revolution. But we've now had a catalyst from the pandemic to change overnight. And so some businesses were in the right place at the right time, like Amazon, ready to go. Other businesses, airlines, travel, leisure, conference organizers, total business model has collapsed overnight and won't look quite the same again. So I'm with is it still, I hope I haven't influenced people. It's gone up to 44%, but I'm with that. I'm with the minority here that I don't think we're ever going back. And I think we should embrace that because there will be more opportunities to come. And am I up against my time there, James? We're good. Okay, good. That was a whistle-stop tour through financial markets and what we're doing right now. And I hope that we will have some questions. So I'm going to go back to, I think, is it Lorenzo?
Yeah, thank you, Helen, for the talk. I think we should just go straight into the questions. And the first one we have is from Echo, who says, are most firms overvalued, and how much does this matter?
Good question. I mean, that is the question everybody in financial markets is asking themselves literally every day. And every day where people feel things are maybe overvalued, they keep going up. So what do you do? It's that same question I asked all of you. Look at that chart of Apple. Do you want to buy or sell? So here's the thing. Value is a driver. Some fundamental investors would say it's the only driver of prices in the long term. But there are other schools of thought that, other factors drive prices. Growth, Apple in the 90s or Ocado right now. So it depends a little bit on what you mean by value and how important value is to the way that you invest. So that's one thing, which is that, and this is another lovely thing about financial markets. It sounds very mathematical and scientific. It's actually quite a lot like an art. I mean, I studied PPE, not as it now is personally protective equipment, but philosophy, politics, and economics at Oxford. And by the way, there's an entire Twitter account called PPEists in PPE, which is every cabinet minister who's done PPE pictured in some protective equipment. But anyway, it's a social science. Financial markets are the same. So you can try and put a number on things. Like you could put a number on a bond. You could look at cash flows and then use your maths to discount it back to the current date based on a discount factor of interest rates and opportunity cost of money. There's a value, but things deviate from their value. And that's always a tension in financial markets. That's point one. But point two is, what the hell is the value in the new economy? It's actually that final question I asked you is absolutely fundamental to what's going to happen to financial markets. Because if you think we're going back to normal next year, and if you think we're never going back, you've got a totally different parameters for whether you'd see value in one investment versus another. In fact, I've got a client who tells me that they're buying European airline stocks because they think, vaccinations are all happening. It's all going to go back to normal. It's come a very low base. And actually, these stocks are really, undervalued and going to rebound. But, if we're not going back to normal, then that's not such a wise investment. So I think, sorry, a long answer to that question, but there was something about being overvalued, wasn't there? Was there a second half to that question? I can't quite remember, just see if I can read it. Did I answer it?
I think you did. We just lost Lorenzo, actually. I'm not sure what's happened.
Oh, well, either he was delighted with my answer or he was disgusted and cut himself off in agitation. But James, did I seem to? I hope I did. Yeah, okay. Next question then.
Freddie's asked what happened with GameStop recently.
So interesting. I wasn't sure whether to include this or not because I didn't know how much any of you were sort of following financial markets. But for those who didn't, GameStop is this kind of traditional place you go and buy video games in America, and it was therefore not valued particularly highly. The stock price was pretty low. Towards the end of last year, some investors started buying it, thinking it was too undervalued. Started sharing this online in various online forums. There's this famous now group on the Reddit channel called Wall Street Bets. And basically, because everyone was at home sitting at their computers, and particularly a lot of people in America couldn't, go and gamble as they normally would, they decided to go and punt around on stock markets and decided to chat about it online, and found, of course, I talked about the wisdom of crowds earlier. If you get enough of a crowd, if you get enough buyers in something turning up every day, then the price will go up, whatever the value should be. And so it's just like, a fruit and veg stall. If a rumor goes round in your neighborhood that, get those oranges, they're bloody brilliant, go and get them now, let's all turn up tomorrow and buy 100 oranges each, then the price goes up. And then especially if it keeps going up, then the sellers are like, brilliant, let's get more oranges and let's buy even more oranges. And then the whisper goes round and more people want to buy and it goes up. But inevitably, what goes up must come down. Not always inevitably, I suppose. But if you're going to whip something into that much of a frenzy, you need to keep whipping it up to keep it going. Otherwise, you'll run out of buyers. And when you run out of buyers, everyone's bought and the price starts falling, everybody panics and they start selling it and then it drops again. And that's pretty much what happened in GameStop. But I would say, I don't want to get too technical here, that market was driven by a lot of option activity, derivatives, which are another thing on top of everything I've talked about. Derivative is like when I told you about the crop guy selling his grains in the future. He was locking in a price now for a future delivery of crops. You can do that with options, except you have the right to do it, not the obligation. Anyway, these options, I don't know how many of you are doing maths. I don't know how many of you have looked at convexity, but effectively it's an exponential rate of change. If that happens in certain markets, that buying activity accelerates and also the selling activity accelerates. And it's all to do with this structure of the market around options. So I would say what happened in GameStop was a classic frenzy moment facilitated by online forums and everybody being at home, and the fact that the options market kind of sped it all up. So that's you can have the narrative of the small guy taking on Wall Street if you want. But there is no doubt, and we know actually, that a bunch of hedge funds also made a lot of money out of all of that. So I like the narrative, but sadly, it doesn't always turn out to be true.
Thank you for your answer, Helen. I have another question from George. He says, do you think that economic news in the media influence is becoming increasingly influential over the psychology of investor behavior in financial markets?
So hang on, what was that? Do I think it's become increasingly?
Do you think that economic news in the media influence is becoming increasingly influential over the psychology of investor behavior in financial markets?
Wow, interesting question. Psychology definitely drives markets, as I've just been talking about. You get these manias, you get fear and greed. It happens all the time, everywhere. It can happen every day that a market can suddenly have an hour of people flocking around something. There is an interesting question as to whether the online world and the speed with which we consume information is increasing that process. And I am open to that. I think that the last 20, 30, well, basically since the late 90s. So 1998, there was a big financial crash relating to the Russia defaulting on its debt. And it almost brought down, well, it did bring down a hedge fund called Long-Term Capital Management, also worth looking at. So basically since then, it also brought down a whole bunch of Asian nations, which was also, shows that it's not just about the market, it's about a country that can end up in debt and defaulting. we've probably had 5 or 6 big crashes since 1998, more than we would have had in the prior 50 years. So it does feel that the speed of markets and the way we consume information is increasing the occurrence of these crashes and of volatility. But before we get too worried about that, you know, I always like to consider historical parallels, and I think we would probably have to go back to things like the Reformation, you know, the fact when the Bible was translated into English. We need to look at things like the advent of the printing press, all things that change the way we communicate and we think, which, you know, in their own ways had an impact on how people invested and traded. So I kind of think, you know, we always go through this, but certainly the ability of the online world to influence us, there's a psychological impact going on. And someone told me recently that the fact we have news in our hands, like it links into our brains differently than reading a newspaper. You can decide for yourself if you think that's good or bad.
Thank you, Helen, for your response. I have another question from Oliver, and he says, do you think the salaries of those in the financial sector are justified based on their contributions to society?
Well, I think if my philosophy hat on, you're starting from the more important premise, which is, do you think salaries should be linked to how good something is in society? Mm. And that depends on your ideology, of course, as to whether you think that's right or not. I think that we live in a capitalist world, and that capitalism has beaten communism, but is going through a crisis ever since the financial crisis, in fact, which is, you know, the question is what ideology really works. And actually your generation, you're the ones, you're going to come up with the next economic ideology, which is great. You're going to come up with whatever works next. And I should say, I helped an MP write a book called Masters of Nothing, and how the financial crisis will happen again if we don't look at human nature. And one thing we looked at in that financial crisis is that although people said, oh, the banks broke everything and free markets are a disaster, actually free markets does not mean unregulated markets. You know, it's like if I put 10 of you on a football pitch and just told, well, if I just put 10 of you in a field and told you to run around with a ball, all sorts of stuff would happen. You actually need a goal, you need lines, you need, you know, penalty areas, you need 25-yard, etc. You know, you need the setup. So, and I hope everyone will be watching tonight. I hope that is actually what is on everyone's mind right now. But the thing about, you know, this concept of salaries and what's justified, it all depends on what structure you put in place and what you consider to be valuable. And I would just say this about financial markets, which is that if you want to change the world, being in the hub of where money meets and where money changes things is actually where you can make a difference. So you could argue it's not the salary that makes people good or bad, it's the person and what they do with it. There you go.
Thank you. So the next question we have is, what is cryptocurrency and how has it affected the financial market?
Oh, before I answer that, James, am I going to get cut off in like 2 minutes? Is this whole thing going to shut down?
No, you should get a quarter past.
Oh, we got, okay, good, right. I didn't want to answer the question, you see. You know, you guys will know more about cryptocurrency than me. You're probably all, you know, crypto billionaires by now. Crypto is something I do not fully understand, and I never trade anything I don't fully understand. Having said all of that, blockchain is clearly a very important technology that should and will spread through the world, particularly the financial world. And that's a good thing. The thing, so you're already starting to see it. You know, part of the attraction of cryptocurrency is this concept of it being decentralized and not in the hands of any particular government. But then you had about a month ago, Elon Musk tweeting that, you know, a group of them were going to get together and try and figure out some rules about how to ensure it was, how the mining of cryptocurrency was going to be, you know, more positive for the environment, which all may be very laudable aims, but it keeps raising up the same point, which is you know, like my football analogy, you've got to have some rules eventually. And it's very hard not to end up with an elite at the top or some group ruling things, whatever happens. And I'm sure you've all read Animal Farm. I'm guessing that's still on the curriculum. If you haven't, you should. You know, the sense that 4 legs good, 2 legs, no, 2 legs good, 4 legs bad. Oh my God, this is horrendous. How embarrassing. James, let's cut that from the recording, that I don't remember that exact phrase, but it's, you know, the idea that when something is kind of the Wild West and new, like crypto, and it's about money and power and all these other things we talked about, and those two things clash, we're going to end up with some messes along the way, unfortunately, I think, which is why I've dipped my toe in only very recently. I keep monitoring it, but we are many iterations away from the final stable crypto that will emerge. What's the next question? Lorenzo, you're back, by the way. Did you go and get a cup of coffee? Maybe for the class? I don't know. Oh, he's off. He's gone. We've lost him again.
I think it's Wi-Fi issues. Yeah, go for it, Yanno.
Okay, Yanno, what question are we up to now?
I've got a question from Henry. It says, how will the increase in inflation rate affect the financial markets?
Ooh, inflation. Inflation is now the #1 question I get from clients in the last year. And I'm tearing my hair out about being asked about it because, and thank you for your question though, but it's frustrating because it's kind of the least interesting thing that's going on. You know, the most interesting thing that's going on is a wholesale ripping up and rearranging of the economy, you know, in terms of what jobs there will be, where people should live, a global workforce that's now all online, everything else that's going on. However, having said that, there clearly is inflation happening. You might all want to watch Friday morning. There's going to be Chinese producer prices will come out. They're at 13-year high. Producer price index in China tends to lead, you know, global CPI because, of course, it's the factory of the world. So if prices are going up in what they're producing in China, then that means that, you know, me over here, I have to pay more to assemble it, and then I'm going to try and charge you more to buy it. So these cost pressures are coming. But there's a very important step in that chain that I skipped over, which is, can I pass that price increase on to my consumer? Now, I can if the economy's booming and everybody's got a job and everybody's spending and everyone feels confident that, you know, hey, I want a TV. I don't care if it's £1,000 or £1,100. I just want it. Then you can pass it on. But we don't yet know. There's these very weird, big, lumpy shifts happening in supply and demand. And I'm still a firm believer that persistent inflation really only comes when you get into that spiral where you get the cost pressure, then you get a lot more demand. And then the key part as well is that wages keep going up, and then there's this spiral and, you know, inflation can take off. We haven't had that. Well, that's the 1970s, basically. We haven't really had inflation at all for like, oh God, 25, 30 years. I mean, I remember distinctly doing an essay at Oxford. This was in like 1999 on, is inflation dead? And that was what people expected. We had a low inflation, low interest rate world for this past 30 years. And the question is, has the economy shifted to mean that we've shrugged that off and we're in a new phase? My sense is no, because one of the big driving features of lower interest rates and lower inflation is demographics. So the Western world is getting older, and sadly that means, you know, less productive, and that tends to mean kind of inflation doesn't really go anywhere, which is actually what's been happening in Japan. So I think very long answer again to this question about inflation. It's in a classic textbook world, higher inflation leads to higher interest rates, which tightens liquidity and eventually puts pressure on financial markets, and those stocks may fall as a result. But we are in such an unprecedented moment. I mean, like, the price of used cars in America went up 90% in a month because nobody wanted to take public transport, and they can't produce enough cars quick enough to get new cars, and you might as well have a used car because it's there on the lot and you can just drive it away. So of course you get that spike when, you know, people could go out but they didn't want to go on public transport. Boom, I'm going to buy a car. Is that going to last? Do you buy a car every month? Unlikely. And are you going to then get more supply coming on when people think, oh yeah, I'll sell my car because the prices are going up, and then of course people produce more cars, etc. Eventually the supply weighs back down again. So I think we'll get pockets of shocking high inflation, which we've not seen, as I say, for 50 years, but persistent inflation, I don't see it.
Thank you for your answer, Helen. Another question I got from Mike is, who are the biggest influencers on the markets?
Ooh. Depends on the market and the time. Because I suppose GameStop, you know, suddenly this group of people on Wall Street bets became, you know, very influential for a period. But at the end of the day, it's the people, it will always be the people with the deepest pockets, the biggest wallets, who can do the most. Now, that's either very successful fund managers who are managing people's pensions. That's one big group. But another big group are governments and their central banks. And central banks in particular have become very important. Very important because they are actually buying assets in markets. They're intervening to, you know, change prices. And the thing about a central bank, and this is a really good thing to look at if you're an economics student, is, you know, how do central banks work? What is their profit and loss? Who pays? They basically have an infinite time horizon because, you know, the Bank of England, well, it started in late 17th century. Anyway, it'll be around for hundreds of years. So it's got pretty deep pockets and it can print the money to buy things ultimately. So there's some very interesting questions there about what should they do, shouldn't they do? They're not elected. I would be amazed if you all knew actually more than one member of the Bank of England's Monetary Policy Committee. Maybe you do. But, you know, those people are some of the most influential people in the country, and people don't know who they are or what they do. And they have very deep pockets as an institution. So in terms of what moves markets, I would say, you know, pension managers, central banks, and, you know, big pools of retail money are the kind of the big players.
Thank you. Another question from William is, where do you see the next major financial markets? Do you believe it will be the Indo-Pacific region, or are there too many political and demographic issues?
So I think that, yes, that's a question there about, you know, markets in places like in Asia versus Europe versus the US. Well, emerging markets generally have always been a group of countries that investors have looked at as a good place to invest, because by nature of being an emerging market, they tend to have much bigger growth rates because they're you know, moving up into bigger, more developed markets. And it's the developed world that's slow and stodgy and boring and getting old and not doing anything. So that's always a question, is, you know, what are relative growth rates? But there's also a geopolitical question. For example, you know, what do we all think is going to happen in the years to come when we continue to rake over what's just happened to us? And will there be a backlash against China and producing in China? And will people, having gone offshore because it was cheap, now don't want to touch anything that's come from China and bring it onshore? And will that be successful, and will it work? So I think, you know, if we're looking at sort of the relative continents, what I'd really be looking at for the future is this new economy we're looking at. What sort of sectors will be winners? To me, it is anything that does well with the virtual world, technology in particular. And then I say, okay, who's got the tech and the skill sets to do it well? Well, pretty much the biggest technology companies in the world, mostly in America, but China and Asia generally have really got an incredible boost in their tech companies. I mean, just watching the Euros, as I'm sure you all are, I'm quite amazed that the sponsors that are popping up these days. One of the big ones is Alipay, which is is a Chinese business. It's an online payments platform. It's only part of their business. It's one of the bigger companies in the world, and so I can tell you this: 20 years ago, we wouldn't have had Chinese advertisers at the European Championships. So it goes to show, how those nations are really developing. So I think there's, it's a balance of where's the technology, but where is the politics as well.
Thank you. The most liked question is, since you mentioned the game tonight, what's your score predictions?
Oh my God. So I cannot in any way say anything because I don't want to jinx it at all. So Euro 96, so the World Cup 1994 was my first introduction to big tournament football, which I loved. Very disappointing final. I was traumatized. Roberto Baggio missed his spot kick. I loved Italy. I'm not going to be, by the way, if we end up facing the final, I'm obviously not going to say that. But, Euro 96 was incredible for me. In fact, it should be incredible. It's a similar stage to you guys. I was just finishing my A-levels. It was being played in Britain. England looked like this amazing team. It was so exciting, and it obviously all turned to disaster. So I have a checkered history, a trauma of more than 40 years of hurt following English football. So I really wouldn't like to say, but this is a formative moment for you guys. And in fact, Gareth Southgate wrote a really good letter, an open letter, Dear England. It was something like the 6th of June in something called the Players Tribune online. Have a read. And he talks about how football, it's why does it matter so much to people? It's not just because we care about the team and the match and we're proud and it's our nation, etc. It's about our lives. Our lives are marked by these events. Obviously, if people are listening to this thinking they don't like football, then I've probably lost you. But there'll be some other event, I suppose, that will be of interest to you. But do not underestimate, by the way, the economic impact if England gets to the final and wins. My goodness, the lift to the mood of the nation at a time like this. Don't forget the political impact of Britain leaving the EU and then winning the European Championships in London would be like, blitzing the world stage of Britain still exists. So we didn't just disappear after leaving the EU. May not agree with it, but Boris Johnson is going to get one hell of a boost. What a lucky man he is. There he was, London mayor in 2012, when we all had that nice joy of the Olympics. Now he's potentially going to get another sporting boost. There will be, real economic and political impact. I can absolutely predict that.
Thank you for your...
What do you think, Yano? Do you want to make a prediction?
No, I don't want to do that.
Okay.
The last question is, describe your perfect portfolio.
Oh God, that's the last question. Oh yeah, really easy. I'll just give away a way to make millions, which I wish I knew. Otherwise, I'd be this. Behind me would be a beach in Bahamas rather than this. But no, I mean, look, the classic response on portfolios is be diversified. I talked to you right at the beginning about risk and return. You put all your eggs in one basket, could go brilliantly, could go an absolute disaster. So it's always prudent to have a bit of a balance, whatever that is, whatever you're getting involved in. So for my mind, given I think we're never going back to normal, there's some companies I wouldn't touch, and there are some companies I think will continue to do brilliantly. So yeah, I clicked buy for Apple. I'll leave it at that.
I think those are all the questions we have for today. I would like to say on behalf of everyone here, thank you, Helen, for the insightful talk to come speak to us. I'm sure everyone here really appreciates you putting us in for a good, instead of next year's macroeconomics course.
Very good.
And just a quick reminder to everyone that the next course starts at 10:30.
Great. We're going to get kicked off, James. But yes, please do contact me directly. Any further questions? Thank you, everybody. It's been great.